Hey traders, this is Blake Morrow with Trader Summit, and it's Friday, and I have Mr. Jim Welsh with us. So let's bring him in from Macro Tides. Jim, how are you?
I'm good, Blake. How are you doing? And who's going to win the Super Bowl?
Well, I'm going to go for the our home team quarterback or our hometown quarterback Brock Purdy from Gilbert, Arizona. So I'm going to say
Okay,
49ers
sure.
naturally. But
That makes
you want
sense.
it's like you want the underdog to win. I guess they're the underdog. It's gonna be I
No,
think
no,
it's
they're
gonna be a great
favored by, I
matchup.
think, two or 3 points.
Yeah,
The Niners are,
it's gonna be a good Super Bowl, I feel.
I hope so. Hopefully,
Yeah.
there's a lot of scoring because that's
Yeah.
fun. And
Yes.
hopefully, it comes down to the last possession because to me, that's the way the football season should end.
That's
A
right.
cliffhanger, irrespective of who actually wins. I mean, obviously specific fans are going to have a disagreement with that, but just for us football fans, it's like, okay, let's have a good game. Right last minute, someone's going to maybe make a drive. Anyway,
Right,
so
right. Well, who keeps scoring are the Bulls right now, Jim. You take a look at the stock market.
nice segue.
Yeah, the stock market just rallying. You got the S&P above 5,000. You got the Nasdaq 100. Just ripping. Dow's coming
Yep.
off a little bit as you got a little bit of rotation in the markets. But how are you feeling about this market at this moment, Jim? I mean, with the stock market as strong as it is.
Yeah. Well, I'm going to, I guess, disagree a little bit in terms of stock market being strong. What we are seeing is extreme strength in semiconductor stocks. I mean, this week, one of them, ARM Holdings, I think it was up over 100% this week. Applied Materials up 30 some percent. So what we're seeing is this concentration in semiconductor stocks, and that's pulling up the Qs, the Nasdaq 100, and then the S&P is kind of getting dragged up. And in the meantime, the broad market is languishing and not participating the way one would normally expect. So my take is we're nearing a top, and I think we're nearing a point where at least a 3%, maybe closer to 7% pullback is coming. So once those stocks, weaken that have just really been going nuts,
Yeah.
um, then it comes down to, well, will the small cap stocks be able to pick up the load? I don't think so.
So, okay, you don't think the small caps are going to be able to pick up the load? What I mean, I know you're like, I think the market pulls back 3 or 4%.
No,
Sounds
three to
reasonable,
7%. Three to
huh?
7%.
Three
Three
to
to
seven
seven
percent,
percent.
3 to 7
Yep.
percent sounds reasonable, but explain to me why you feel this way at this time.
Okay. Well, we're going to preempt the charts
Okay,
because if you want to jump ahead real quick to the S&P chart,
I'll pull
um,
that up for everybody.
yeah,
Yep.
why don't we? And there were for other charts, the S&P is making new all-time highs. If you look at the RSI, this is the third negative divergence. It's like how many charts can we review? But that's out there. Okay, so what we can see, obviously, top panel, the S&P continues to or keeps grinding higher.
Yep.
The bottom panel is a 21-day net advances minus declines as a percent of all the issues traded. So what we can see is they were very strong going into late December. And then the high about a week and a half to 2 weeks ago, late January, a lower peak, and it's barely above zero right now. Now, a little while ago, I looked at breadth and it was flat for today. So my point being is if you look off to the left-hand side, the far left on that indicator, you can see as we approached the July peak, you had a similar divergence where the S&P went higher, not quite as extreme as we're seeing today, and that oscillator percent registered a negative divergence. So to me, this is why if those stocks that are really running furiously will have any kind of a profit-taking spell, this indicator is kind of saying the odds are that the broader market isn't going to come to a rescue. And that's why I think we're setting up for a pullback. And like I said, the RSI on the S&P is recording its second negative divergence. We're making a new high, and the RSI is below where it was the last two times that the RSI had a peak. So number of stocks making new highs as a percent, similar chart as this AD stuff. So technically, under the surface, there's weakness. If a reason to sell materializes, that's where we're going to get a correction. The magnitude of that reason to sell will dictate whether it's 3.5% or closer to 7%.
Well, how about if it's 7%? Are you going to at that point in time say I need to be buying stocks, or are you going to be looking at other things, maybe making the decision at that point that maybe it could be a bit greater?
Yes.
Okay.
Great question, because if this decline, first of all, if it happens,
Yeah.
number two,
If that's one if, and there's a lot of ifs here. So
yeah, as always, it's like the pitch comes in and you got to wait for the pitch to come in before you can decide whether I'm going to swing at it or anything else, right? If there's a 5-wave decline on the S&P during that correction, that to me would imply that, okay, the tide is turned. After 5 waves, you're going to get a retracement bounce, and that bounce should be shorted because we're going to see another period of weakness following that. So I'm waiting for the clues. If the correction is 6%, but it's a B, C, then that should be bought because the odds are you're going to go back up and make a higher high.
got it.
So that to me is just that there's enough evidence now to suggest that a pullback is coming. And, buying here, I don't think is a great idea. I'm actually partially short from about 49.50. And I'm looking to add to that short when I feel more confident that, okay, we're rolling over and we're going to begin that correction.
Okay. All right. Well, let's look, we're going to come back to the markets, and if you guys like, Jim's technical views of the market, make sure you give him a thumbs up. If you have any other views, you think we're going into more of a blow off top type of situation, maybe. If you do,
possible,
jump down in the comments below and mention them there. Now, Jim, let's shift gears and talk a little bit about the economy, because you brought a few charts highlighting some key specifics about the U.S. economy. But how are you feeling about the U.S. economy right now? Because I mean, we're not. It seems like the no landing, soft landing crew is in the driver's seat right now.
Yeah. Well, the January macro tides I went through. Now, as you know, I was looking for weakness in the fourth quarter. We did get a slowdown, not as much as I was expecting. But part of that, as I explained in December as well in our calls, were the San Francisco Fed has been estimating excess savings. In September, they said, hey, they're pretty much done. Well, then in early November, they came out and said, no, there's maybe 450 billion left. Also, credit card, or pardon me, gift card spending in January of last year was really strong, and the percentage of people that are receiving and giving gift cards has increased a lot in the recent years. My guess was that as we get into January, we would see people go out and spend some of those gift cards that they received. So I felt that going into the first quarter, the economy was still going to be okay, which was one of the reasons why I didn't think there was going to be a rate cut in March, why the idea of 6 rate cuts this year are, I think, delusional, unless, of course, by mid-year we see more pronounced slowing.
Yeah.
So I think the economy continues to be okay, but consumer spending has been the linchpin. It makes up of almost 70% of GDP. And I believe that what we're seeing slowly but surely is weakness from the bottom up. So the first few charts we're going to look at is examining that. So one of the things I've heard people talk about is if you look at credit card debt as a percent of disposable income is gross income minus all your taxes and everything else. So it's what's left over, it's disposable, right? And right now, credit card debt as a percent of disposable income is at about 5.5%. And prior to the pandemic, it was the high was 6.4, but you can see it, it zigzagged. It probably at times was very close to where we are now. But the
Yeah.
idea being, and of course, the financial crisis brought credit card debt significantly. When the government gave out a lot of money in 2021 and 22, people paid down over $100 billion worth of credit card debt, and now it's been ramping higher. So, but this is the argument that people say, hey, the economy's just fine. Credit card debt is no worse than it was back prior to the pandemic. Yes, that is true. Obviously, the trend is certainly up, and it's up somewhat aggressively. But the next chart, I think, needs to be incorporated with any discussion about this because it says of disposable income. Well, if you break down total income, what we see is the top 10% have more than half of all income. The bottom half is 16.5%. That's the yellow and the blue. The bottom and the 50 to 90% is 30.8%. So my point is we have, and this is, the reality that we're dealing with. Income inequality is greater now than any time since the 1920s. That is what it is. All right. I'm not trying to make a political statement here. I'm just saying, all right, if you look at disposable income and the fact that it's skewed to the wealthy, that makes that number a little less meaningful in terms of what's credit card debt as a percent of disposable income. Because in my view, those at the bottom 50 are the people who've gone through most of their savings, if not all of it. They've been ramping up credit cards that buy now, save later, or pay later has zoomed. And the interest expense on all these items are north of 20%. Very significant. So that analysis explains the next chart, which shows the delinquency rate on credit card debt and auto loans. And again, it's the slope. Look at how aggressively that slope is. I mean, it's kind of like if that was a stock, you'd say, hey, it just broke out. It's going higher. It took out the highs from 2019. It's going up, So again,
I've read somewhere, Jim, and I can't remember where it was, like in the last few weeks, like Google searches for return car are at the highest, like people just want to turn in their vehicles that they bought over the last few years or whatever the case
that was
may be.
the next chart I was going to show, and I thought, hey, I'm getting too many charts here.
Okay.
Because give my car back and credit card debt. Yeah, I mean, it's again, the slope is like this on those searches. Now we're talking a small percentage of total consumers, but my point is for someone to use the argument, well, the economy is just fine. Credit card debt as a percent of disposable income, it's not really worse than it was prior to the pandemic. And it's like, okay, let's analyze that a little bit in more detail. And so my point is there are stresses that have been building, continue to build, and will get worse in coming months and over the next 12 to 18 months from the bottom up. And we know housing prices went through the roof. And obviously, some stocks, in terms of the S&P 500 and so forth, are making new all-time highs. So the income inequality is mirrored by wealth inequality in terms of the top 1% owning more wealth than the bottom 50%. Well, if your house just went up by 30-40% and your income is doing really pretty good, and you got money in the bank because you got savings and you're making 5% now instead of 0, those are the dynamics I think that have been helping the economy. If we see a meaningful correction at any point in time in the next 2 years in the stock market, that's where we're going to see the higher income folks, they're going to take it on the chin, and that will have an impact on spending for a period of time. But my only point in raising all this, Blake, was the economy's in good shape, but excess savings are not inexhaustible. And, we are seeing from the bottom up signs of stress building in the economy. And I think they're not going to reverse if the economy slows. They're going to intensify and then capture more people who will be experiencing that stress. And if the unemployment rate starts to tick higher, as I think it will by the end of this year, it becomes a little bit of a snowball.
Well,
So,
and one of the things that when you say it's a bit of a snowball, I really agree with you, Jim. The reason why I say that is because the jobs that have been created are really, just kind of they're not your white collar jobs. They're a lot of more blue collar jobs. Like, if I always use the analogy on some of our shows that we do is, if I was like a junior engineer somewhere and I lost my job, sometime over the last 12 months, I might have picked up a job at Home Depot or Costco and doing another job at the same time. Therefore, now I'm working two jobs, but I'm, because I can't find that white collar
the
job
job I
right now.
really, yeah, right,
Yeah.
right.
And
Warren notice. Okay, go ahead, finish.
no, I was
Sorry.
just going to say
Yeah.
if those go, they tend to go rather quickly because employers are more apt to cut those jobs than some of the jobs that they're seeking because they keep because of the more skilled employee, if you will.
Right, right.
So
The other thing is WARN notices, WARN, are basically notices that companies have to provide employees saying, hey, 60 days from now, you're going to be out of work. So those have jumped in the last couple months. It's kind of a forward indicator of, okay, that 60-day period is up. More people are going to be out of work. We already know it's taking longer to find a new job, to your point.
yeah,
So again, this is happening in slow motion to some extent for a lot of different reasons. But for me, I believe that after this period in the first part of this year where the economy continues to perform okay, that we are going to see a pronounced slowing. And I think there'll be at least one quarter of negative GDP growth this year. And if things come out of the woodwork, like commercial real estate late this year and so forth, recession becomes a much more distinct possibility. So the economy's okay for now. I just think, and people have totally, again, remember, in the spring of last year and in 2022, oh my God, we're going into recession. And now no one is, I shouldn't say no one, much fewer discussion of a recession is happening. In other words, okay, we don't have to worry about that now,
right.
and that, hey, it may be the case. But I'm trying to pay attention to, okay, what could go wrong that undermines that narrative? And I think that's one of the things I try to do. I think it's a skill or an effort that anybody involved with financial markets need to do is when there's a narrative that takes hold and is widely embraced, you have to start looking at, well, what could cause that narrative to change, whether it's positive or negative, and challenge it and challenge yourself.
Yeah.
In terms of, okay, it's human nature is, okay, here's what I think is going to happen. So I'm only going to be looking at the stuff that supports that. No, you need to look at the things that challenge what we think is going to happen because that's how we stay on our toes. And I think that's one of the most important lessons any investor can learn and then begin to employ.
That's a great point. All right. Well, you talked about the S&P earlier. Let's jump into the
Yep.
next chart, which you had Russell 2000. Tell us a little bit about this chart because I know your time's kind of limited here,
Yep.
as is mine actually. So, what do you see on the Russell?
Just that potentially we could see the Russell get above 2011. In other words, A, B, complete the C by getting above 2011. Again, I don't believe we're going to see this thing expand and the Russell is going to run above 2072. So we had a decline. We're getting an ABC, I think, retracement. And then I think it's going to be followed by another decline that'll take the Russell below 1913.
Woo. That's gonna upend a lot of analyst forecasts this year if that takes place.
Yeah, and again, we shall see. The table is set for a pullback in the market. It just comes down to what the trigger will be, and if it's a decent reason to do some selling of and beyond. Okay, some of these semiconductor stocks are up a lot. I'm going to take some money off the table.
Well, maybe that has to do with what's happening in TLT and the bond market and yields. I
Yeah,
mean, you got TLT. Looks like yields are going to rip higher, and that's going to take the dollar up with it, I think. But what are you seeing here with TLT?
I think Treasury yields are indeed going to be working their way higher. I believe you had an A wave decline, tick higher in Treasury yields from late December until mid-January. Then we had a retracement rally, carried a little bit more than what I expected for one day. And then we've been working our way down. I think TLT is going to take out 93.10. 91.50 is the 50% retracement from the low at 82.42 to 100.57. There's no reason why I can't do a 618. That's a possibility. A and C would be equal at 91.20. But a lot of times C waves wind up being longer than wave A. So you're right. That this could be a pressure point where all of a sudden, whoa, all of a sudden, if we take out the high in yields that we saw a few weeks ago, then all of a sudden I think people start to pay maybe a little attention that, oh, maybe that's the trigger to take some money off the mega cap stocks and the semis.
All right, and the next chart that you brought up is going to be of the dollar. So
Yeah.
how are you reading this?
Well, I've been constructive on the dollar since late December, expected a rally to 104. Said, okay, I think we're going to get above 104.26. That was the wave four of lesser degree. It did. But, just looking at this, Blake, to me, it looks like it still wants to go a little higher. So to your point, Treasury yields tick a little bit higher, maybe gives, a tailwind for the dollar. My view is once this rally is over, that you had 5 down from the high of 107.34. This is a retracement rally. And then there's another decline coming that will take out that 100.62. I think there's a shot that the dollar will get down towards 96 sometime in 2024.
I
So now
hear
we
what you're saying, Jim. I just don't believe what you're
yeah.
saying, but I hear what you're saying. Okay, now
Yeah.
the last chart to put this all together is your chart on gold. So, how do you feel about the gold market? Because it's trading kind of heavy, right?
Yeah, it is. I mean, and again, that you hit a low, you bounce to 2061, then down to 2002, then 2064. Well, that can be kind of like an irregular ABC, from the low, the bounce up to 2061 was A, B down to 2002, 2064, and it's like, okay, now you're ready to get a dump. And to me, it just like you're saying, it's trading heavy.
Yeah.
And you take out 2002, one has to assume there's some stops underneath there. That then brings the 2007 or 1974 low into sight. And as we've talked over the last month, that the rally from 1812 to 2122 can be a big ABC for a B wave. And so the decline from 2057 to 1812 was wave A of 2, ABC up for B of 2, and now we're working on wave C of 2 that will take gold down below 1812. So I just think, it's not acting good. The chart looks that even one wants to be optimistic, the next 40 bucks or so looks more likely to the downside.
Well, that's I know a lot of people that trade gold. It's really one of the more active, especially with like international investors. It's one of the more active instruments that you're going to find. I was talking to my one of my colleagues that I do shows with from
Yeah.
Australia, and I know his brokerage firm does a lot of business in gold. A lot of gold bulls are going to be a little disappointed here if we see a move back below 2000. I think that's going to be a big psychological level that they're not going to want to give up easy, but if it happens, that might get a
Yeah.
little scary, right?
Well, again, when you're blindsided by what you thought was going to happen, really starts to go the other way. It's very hard. And again, I'm just going by chart analysis that a decline below 1812 is possible. Is it a 20% probability? I don't know. But near term, it definitely looks like we're going lower. And as you know, I'm in the camp that the rally up to the high in May was wave one of a much larger advance. So wave one, and then potentially A, B, C for two, and then I think gold is going to 2,300 or so. So it's
Yeah,
just a
so it's
question of
like
finding the next low.
if you're a bull, you got to be thinking, hey, if we see 1900, if we see 1820, if we see whatever it is, you got to be looking for a move back up into all-time highs, basically. So,
Well, yeah, I just don't want to sit through the decline if that's what's going to transpire.
sure, of course. And most traders will be thinking that, investors should be thinking opportunity. So,
Yeah,
anyway,
absolutely. I mean, to me, if that unfolds as I just described, that'll be a significant buying opportunity.
yeah.
Because 2,300 is a modest upside target. In other words, it could be 10 to 20% higher than that
Right.
out a year or two. So, but like all these markets, you take them one step at a time. So
Absolutely. Jim, I'll tell you, I love meeting with you every Friday. For me, it's great. And if you guys haven't subscribed, now remember, when you subscribe to a YouTube channel, it's free. A lot of people misinterpret that. They're like, wait a second, if I subscribe, am I going to get charged? No, YouTube channels are free to subscribe. So subscribe to our channel, Trader Summit, and then also hit the bell icon. So every time you get a new interview from Jim, you're going to say, oh, shoot, I can go watch that right now. So make sure
I better
to do
drop
that.
everything.
and also give him a thumbs up, because that's free. But what else is free is send Jim an email. Jim, what's your email?
Yep. Jim Welsh Macro at Gmail. And I'll send you a recent report so you get a better idea of some of the stuff I talk about.
100%. I think that's a great gift. So, guys, gals, I know, Jim, you need to cut out of here, and I do too. So have a great weekend.
You too.
Good luck to you suckers in Kansas City. No, really,
Wow.
I hope it's a great Super Bowl for everybody. A lot of good entertainment. And I'll look forward to catching you next week, Jim.
You got it, Blake. Thanks so much.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.